So Taylor wanted me to kick things off. He's like, what would be the most exciting thing to get everybody awake? Let's talk about mortgages, right, guys? Awesome. Yeah, so I'll jump into to my presentation and talk about creative solutions for real estate investors. And of course, I couldn't get up here and not talk about interest rates. Obviously, everybody's wondering and worrying about what's happening with interest rates. So we do need to talk about that and address the elephant in the room. But first, let's talk a little bit about what's happened over the last couple of years. It's been a roller coaster ride. It's been crazy. It seems like, as a mortgage broker, I'm either too busy or not busy enough for the last 3 years. Too busy or not busy enough.
I just
COVID hit, all of a sudden, oh my gosh, what's going to happen? Am I going to have to let my staff go? Are we going to, nobody's purchasing anything, nothing's happening. And then 2 months later, oh my gosh, I actually need to hire more people. Never mind. 2 years of that, and then all of a sudden, oh, now the market's slowing down. Now I have too many staff again. And then probably after laying off a couple of staff members, all of a sudden, 3 or 4 weeks ago, the market turns up again, and it cranks up. So it seems like it's just up and down, up and down. And as I will get into in a little bit, I think the interest rates will be a little bit of that roller coaster ride that we're going to see. So let's talk about interest rates. And one of the things that I'm going to pull up here to address interest rates is going to be something that's really, really boring and lame, and that's bond charts. So the first thing that I want to talk about is the Bank of Canada and the direction that they had to take here, which was either they raise rates to combat inflation and they risk a recession, or they go the opposite and raise rates more slowly and risk inflation running away, and have a lower likelihood of a recession. And we know which direction the government has taken, obviously. They've obviously chosen to say, you know what, we really need to make sure that inflation is kept under control. And they've, of course, risen rates quite a bit over the last year. So what happens here, and it's important to make sure that you understand the distinction between the two, but there's a reason that I have a bond chart up here. And the reason for that is that although the Bank of Canada controls what's called the overnight lending rate, which is what the banks set their prime rate on, they do not actually control the bond market. They don't have a direct control anyways over the bond market. And so the bond market is actually how fixed rate mortgages are priced. And the reason for that is that lenders lend out to people like you and I, and then they bundle out the mortgages and sell them out the back door. Who's seen the Big Short? Come on, my nerds, put up your hands. There we go. A lot of people. Awesome. So in the Big Short, they discussed and talked about how what was happening is they're bundling up these mortgages and selling them, and the rating agencies are stamping them AAA, but they're actually full of junk mortgages. So that act of securitization still occurs, and that's actually the largest way that most major banks fund their mortgages. And so if you're an international investor, and you can buy a bond, or you can buy other similar asset classes like mortgage-backed securities or bundles of mortgages, then what ends up happening is as bond markets move up and down, so too do mortgage rates. And so this is the chart that I watch probably every day. I pull it up, see what's happening in the bond market, because this is my little seeing glass. If bonds are going up, I probably have a 2-day window or a 3-day window before interest rates start to move up with the major banks. So a couple things that I want to point out here, because one of the things you're going to notice here is that bad news typically pushes interest rates down. And then what you would normally consider to be good news actually pushes interest rates up. So COVID, obviously with COVID, interest rates collapsed considerably. And central banks and governments forcibly tried to push interest rates down as much as possible. You had a $50 billion bond sell-off. That was the little tick up way back during COVID. Omicron, when Omicron was becoming a concern, all of a sudden the bond market started to decrease. And so interest rates short-term actually started to go down. Ukraine, so when the war in Ukraine first started, all of a sudden, that's bad news, interest rates started to drop. And then all of a sudden, oh, never mind, that actually is going to cause a significant amount of inflation. And all of a sudden, the rates started to go up quite a bit. And the last one here is quantitative tightening, and this is one of the mechanisms that central banks do have on impacting bond markets. Is one of the ways that they get money into the system is they can either print money And one of the ways that they do that is they literally go out and they say, hey banks, we're going to buy a bunch of your bonds and a bunch of your assets, and they pop money into their bank account. That's literally how they do it. Now the other opposite way of doing this, if they want to reverse that, is they sell off bonds and they sell off those assets and they start to put them on the marketplace. And when they do that, those asset prices go down, but the bond yields go up. So we've seen interest rates obviously rise considerably. If you look at where bonds were when we had COVID, they were about 0.4% for quite some time, quite low. Now they're at 3.75%. So in theory, that means that interest rates should have risen about 3.3% over that time period. And that's about how much they've gone up. We were looking at rates that were around 2 or just under 2%, and now we're just a little bit over 5% for most mortgage terms right now in Canada. Now this is what we see on just in the last couple of months. These, by the way, are massive swings in the bond market. These are huge. And there's different events that are coming up here. So if I start to zoom in on this, Bank of Canada announces that they're going to pause hikes. Interest rates start to fall. All of a sudden then, there's US CPI and inflation numbers. All of a sudden, oh my gosh, never mind, the US might be going up in interest rates. Now the bond market reacts and starts to go up. And then we have bank failures. Who remembers the SVB situation, Silicon Valley Bank, right? All of a sudden, interest rates plummet again. And now, all of a sudden, oh, never mind, there's more US inflation and CPI numbers coming out that are concerning. And so this is going to be a bit of a roller coaster, and it's not common that you see the bond market swinging by 0.5% in these short windows. These are really, really significant swings. Of course, we've got the Bank of Canada, and they've raised rates considerably over the last little while here, up to the highest levels we've seen in 22 years, which is quite crazy. Just as of Wednesday, they've bumped up their the overnight lending rate to 4.75, and that means a prime rate of 6.95%. You know, it's interesting because we have a lot of clients that typically would borrow money off of their line of credit to invest and create a spread between their cost of borrowing and what their returns are. All of a sudden, people are looking at that and saying, my line of credit is going to cost me 7.5%. That's a pretty high interest rate, and it makes it a lot harder to justify investing in that type of climate, especially if you're borrowing money to invest, right? So the Bank of Canada had paused, and now all of a sudden there's a chance that they go up further this year. So Wednesday was not perhaps the only hike that is being priced into the marketplace. The question of will rates go up or go down is starting to become a little bit clearer, although 3 or 4 weeks ago, it seemed to be clear that they would likely stay flat and then start to decrease in January or a little bit later than January. And now it seems like that has completely flipped. So what I have here is there are people called overnight index swappers. Basically, high level, these people bet on what the Bank of Canada is going to do. To tell you what's going on here and what they're talking about for the implied rate, what's being priced into the marketplace right now is about 1.5 increases between now and the end of the year. So these guys dial it in very, very specifically, and these people are generally more accurate than economists are, like overall. And it's probably because they're betting using their real money, and so they're really, really good at this kind of stuff. So these are the implied rates. So this means that if 5.06 is what they're expecting, the prime rate in Canada is 2.2% higher than this number. So again, it's not a rounded quarter point number that you would expect. It basically means that they're betting on about 1.5 increases to the prime rate this year, which is a bit surprising. And to many of you that have variable rate mortgages, a bit concerning as well. On the flip side, this here is the 2-year and the 10-year bond spread. And the reason that I have this up, and I know, I'm sorry guys, I know I'm putting out the most boring slides first thing in the morning. I get it, okay? But this one's really, really important. Because this spread here, what this is implying is that when short-term money is more expensive than long-term money, it generally means that the risk of a recession is right around the corner. And the bigger that this gap is, when you see that number down that low, this goes back to 1995. the implied risk of a recession coming up is extremely high. Now, what happens in a recession? What do central banks do with interest rates? They go down, right? So it seems like the Bank of Canada and other central banks are teetering on the edge here, trying to combat the inflation, but knowing that every little extra quarter point that they go up is increasing the risk of a recession soon. And it also means that in general, the harder and faster that they go up on interest rates just means that in general you'd expect that the timeline on when they have to decrease them will be sooner and be more aggressive when they start to come back down again. And so it'd be interesting to see exactly what happens, but this spread is significant. It's a very, very large spread. You don't typically see it at that 1% level. And of course, the tough part about predicting interest rates is that usually it's the negative news and bad things that happen around the world that push interest rates down. So 9/11, COVID, the subprime crisis, Brexit, all of these large international events typically push interest rates down, and they're hard to foresee. And so my expectation moving forward is that there will be another SVB type of situation. I've been hearing that, that because interest rates are rising, bank deposits are decreasing at an accelerating level. People are dipping into their savings to service their debts. And what happens when that occurs is the banks have less and less liquidity, and it becomes a liquidity crisis, and SVB was a liquidity crisis, and there probably will be more of these coming up. And this is a big concern, of course, for major governments, is ensuring that the monetary system has faith in it. And so we're really teetering on the edge here on exactly what's going to happen. But as of right now, people that are betting on what the Bank of Canada and whatnot are going to do are betting on the interest rates likely staying flat or increasing this year. 0.25%, maybe as high as a half. I would be surprised if it's a half, but I also was a bit surprised that they went up on Wednesday. So I'm out of the game on predicting interest rates after this last little while. It's been really, really challenging to know what's going on. On the flip side, fixed rates, the expectation, so people that bet on where bonds will be in the near future, bond market, are expecting it to be flat to decreasing. But just as we showed a few slides ago, it's going to be a roller coaster in between. So expect it to go up and to go down. Now, what does this mean for many of you? This information and what you take out of it, one of the things to consider is that for some borrowers, it may make sense to lock in your variable rate into a fixed rate. And so when earlier in the year, only 3 or 4 weeks ago, before the Bank of Canada increased interest rates, or at least it seemed like they're going to, it did seem in a model that I built that if the interest rate stayed flat for the rest of the year and then started to decrease by 0.25% starting in January of next year, every quarter, so every 3 months, they went down 0.25% for 2 years, and the prime rate went from 6.7 to 4.7 over that 2-year span. A variable with a good discount, like if you have a variable at prime minus 0.8 or 0.9, that would outperform a 3-year fixed rate. And at the time, 3 or 4 weeks ago, 3-year fixed rates were around 4.99%. So it did seem like hanging on to your variable rate mortgage may have resulted in less interest over a 3-year period than locking it into a 3-year fixed. Now, I have to redo my model, which happens all the time, to see now what happens if fixed rates for a 3-year fixed are 5.59, and also the Bank of Canada may not even staying flat, but maybe further increasing. And now it seems like the likely outcome is they're looking at decreasing possibly around halfway through 2024. So now that outlook is getting pushed out further as far as when they start to decrease. Okay. So one of the things we're looking at for a lot of borrowers is even if over a 3-year span you would save money by being in a variable rate versus being in a fixed rate, the conversation sometimes is, can you hang on long enough to realize the savings? Because the savings is probably all in year 3. Because year 1, you're paying more in the variable than the fixed. Year 2, it's probably about the same. And then year 3, you'd save money by being in the variable. But if you can't ride it out for years 1 and 2 at that higher cost, then it may be worth considering locking into a variable or into a fixed rate. And some lenders are much more competitive than others right now. In particular, a lot of credit unions had held out and had much lower interest rates until literally one of the credit unions is going up on Monday, and a few of them had already gone up last week. But in some cases, credit unions still haven't fully risen up because they don't react as much to the bond market. They don't sell as many mortgages in that market, so they don't react as much to it. So you might find that a credit union might have a better offer. And so some of our clients are running the numbers to see, well, my bank offered me 3.7 to lock in, but I can get a credit union to give me 3.39. You might actually be better off to pay the penalty and move it to another lender. So just something to look at. It's very easy for us to run those numbers, and you just say, Kyle, my bank offered me this to lock it in. Does it make sense for me to look elsewhere to see if maybe somebody else is giving me a better term, better rate? Now, on top of that, we've had a crazy real estate market, and the question I get a lot is, how the heck are people buying properties in today's market with interest rates as high as they are? Because remember, there's the stress test. So as much as rates have gone up, you have to stress test it at 2% above that rate. And so we're getting a lot of questions about how people are possibly buying properties in this market. Not to mention, there's a couple of things that banks have been having to adhere to and address as well. There's a lot of government pressure, and there's government pressure on 3 different things that they're talking about right now. One of them is changing the way that they will allow lenders to treat rental income on properties. So the property that you are financing, the subject property, they're removing what's called a rental offset. And so it just allows you to use more rental income to qualify. To give you an idea, a lot of lenders are changing from an offset to an add to income method, and it literally on $1,000 a month in rent, it changes the amount of rent they use from $800 to $220. It's a significant decrease. Now, interestingly enough, credit unions are provincially regulated, not federally regulated. They do not need to adhere to these rules and guidelines. So you may see for the next little while, unless credit unions decide to adopt, that credit unions will be able to qualify you for a lot more on a rental purchase than a major bank will. So something to watch out for. One other thing that's been on the table, and I'm not sure if they will follow through this or not, but there's been a lot of discussion about raising the down payment minimum for rental properties from 20% to 25 or even 35%. I think 35% would be quite aggressive, but 25% down as the minimum down payment for a rental may be on the table, which is something to consider as an investor. That does have a large negative impact on your return on investment. And thirdly, there's also talk about changing from a debt servicing qualification to what's called a loan to income qualification. And as a mortgage broker, I actually think this is really great because instead of us having to say, okay, you qualify for this much with this lender at this rate, and then you qualify for this much with this lender at this rate, because I have to add the stress test to every different interest rate and different lenders and even the same lenders, different terms, and you qualify for more or less. I actually have, in some cases, have to tell a client the only way for you to buy this home is to go at a 5-year fixed, which I'm not a huge fan of right now, because the 5-year fixed is a cheaper rate, and that's the only way you can qualify. The loan to income ratio is just saying what's your income and what's the loan amount in total, and just looking at that. So there's some changes possibly coming down to fundamentally how we qualify mortgages. The concern is how they would treat investor clients. If you have a large portfolio, that loan to income ratio is going to be through the roof. And so it's very interesting to see how that comes down the pipe. So this is all very confusing, very challenging. There's a lot going on. It's getting harder and harder. So we need to talk about how we can get people qualified. There's a few programs that I've been using a lot lately. So for those that are self-employed and are incorporated, there are programs called corporate net income, where the lenders will look at your financial statements and they'll say, oh, you have surplus income in your corporation, and they'll use a percentage of that income as if it was take-home income. So if you're self-employed and incorporated and you can't get a mortgage, but your company is earning good income, but you just don't take it all home, then you may have a solution. So just keep that in mind. A lot of bankers don't know how to read the financial statements to be able to address that. I mentioned earlier, credit unions. We're doing a lot more business with credit unions right now because they're in a unique spot where they can use more rental income than banks can for rentals. And the third one that we're using a lot of is net worth programs. And so a lot of lenders have net worth programs where if you have $150,000 to $250,000 of assets or more, then they have some leeway with their underwriting guidelines. So you could qualify for a larger mortgage. Basically, if your income could qualify you for a $500,000 mortgage and you have $300,000 of eligible assets, then they would add the assets to your amount that you could qualify for on your income, and that would mean you'd qualify for an $800,000 mortgage. So some different programs that are out there. The last thing I want to talk about, which is a big push, is actually CMHC insured multifamily financing. And this is something that we're seeing a big push on from the government. Oh, I went too far. There we go. So if you're buying 5+ units, you can get, it's commercial lending instead of residential lending. And CMHC is an insurer, and they're a crown corporation. And they're really trying to solve the housing issue by pushing on the financing on the debt side, because it's really hard to control municipalities to create more rental housing stock. But what they can do is they can incentivize developers to build more rental housing stock. And the way that they're doing this is they're giving up to 50-year amortizations, up to 95 or even 100% financing if you can qualify. The interest rates are lower than residential interest rates. There's a lot of reasons why CMHC insured multifamily is one of the big pushes right now. Now, for a lot of individuals, going out and doing a large project like this and going through CMHC is too much capital, that you're buying a lot of units at the same time. And this is actually where you could be looking at just teaming up and investing through private equities and being a part of that. Instead of trying to do a deal on your own, instead getting into the deals that have the better return on investment and being a piece of a smaller piece of a bigger deal instead of being 100% of a much smaller deal. So I've already noticed this trend. A lot more people are acknowledging and realizing that this is a really, really good opportunity and trying to get into that. It's just very difficult as a smaller investor to go out and buy a 10-unit building yourself. So we're going to find more joint ventures, more people teaming up together, and more people investing through third-party companies. So if you want to chat more and learn more about different creative solutions, we're full of them. There's lots of creative solutions. There are still ways of getting mortgages in today's climate. Feel free to book a consult with us today. I do have, I think, only 50 of my books. So those of you that do not have my book, Rockstar Real Estate Investing, I'll hand some out during the brunch. So please find me if you would like a copy of my book, and I'll walk around and try to hand some out. Otherwise, I'm happy to answer any questions if I still have time. Thanks.